Okay, so today we're going to look at an earnings play trade that I did this last week called the ride or die trade. Now, in case you don't know what ride or die means, I wasn't quite sure. I thought I knew, but I wanted to make sure. So I pulled out the old Chat GPT and I asked old Chat GPT, what does ride or die mean? This is my new assistant, my new source of knowledge. All right, so ChatGPT says ride or die is a colloquial expression used to denote extreme loyalty to someone or something. It implies the level of commitment where the person is ready to face any situation, even the most challenging and dangerous ones, alongside the person or cause that they're loyal to. So an example of ride or die is like ridiculous gangsters, like they'll do anything for the gang, or like bikers, like a biker gang, like the Hells Angels, fight the man, ride together, ride or die to the bitter end. Or the most famous one is probably this duo, Bonnie and Clyde. They're going to ride or die together. They're not going to throw the other one under the bus, and they're going to be committed all the way to the bitter end no matter what. So this trade is perfect and ideal for ride or die investors who are in love with the company so much that they'll just buy their stock at any chance they get. If they can get a good bargain on it. Doesn't matter what anybody else says. It doesn't matter how the company's currently doing or what anyone else says. They're going to ride or die with this company because they're just totally committed to it. And my wife's grandmother was like this with the company, Boeing. She worked for Boeing and they gave her stock and she was a loyal Boeing fan. And no matter what, at any chance she could get, she would get more Boeing stock. And there she is right there next to her daughter, which is my sister, my wife's mother. That's my wife's mother, and that's my wife's what the heck? And that's my wife's grandmother. Grandma May. She was a character. She was this little tiny lady. She had a huge personality and she was funny. She loved that. They're Swedish and she loved that Swedish glug. And she was kind of a little racist, I hate to say. She was always worried and fretting that her neighbors were going to catch her little dog and eat it. But that's a story for a whole other time. Regardless, she was a ride or die fanboy or fangirl of Boeing. And so this strategy is perfect for that, for ride or diers of a particular company. It's an earnings play. And again, this could also work for someone who's kind of speculative or somebody who wants a little bit of excitement and the risk is, just winding up with a stock, like a well-known and good stock. That's the risk. I don't play these usually. I just played this last week because the opportunity was there and I wanted to show an example of how this is done. So we did a Disney play, and God, I've paid so much money to Disney over the years with 4 kids. I mean, we were like huge Disney fans. We would it's kind of tapered down now, but with the first 2 kids, oh my God, we were there like every month we would go there. We spent a lot of money there. And I think Disney's a good company. So anyway, Thursday was Disney earnings, and I just thought it was the perfect time to make a video to show this strategy. And again, this strategy is ideal for ride or diers of Disney. So just imagine somebody who just loves Disney stock, and you can't convince them of anything, no matter what. They're just going to always stay and be committed and a big fan of Disney, and they want to get as much Disney stock as possible, and especially at a discount. So that's where this trade comes in. And there's several different variations on this trade, but the basic one, which I'll hit first, and then I'll kind of go into the other one, is basically a naked put position on Disney. And I was check this out. I was looking for an image to put in here. I'm talking about naked puts, and look what I found online. I guess this is like naked golfing. I've never even heard of such a thing. I guess it's like a real thing. People really do. They have whole associations and societies of these naked golfers. And if you notice, they're all kind of older, like our age. So that's kind of weird. That's kind of like a what the fudge moment. Maybe that'll be the what the fudge moment for this next week. Like, what's behind this naked golfing thing? Seems like it'd be sort of distracting. But anyway, so the naked put, if you don't know what the naked put is, a naked put, or it's also called this cash secured put, and it's basically selling an option on a stock. Usually is done below at a strike price that's below where the stock is currently trading at. And you just sell the naked put and you bring some premium, you bring some cash into your account at the moment you sell it at this lower strike from where it's currently trading at. And the thought behind it is that if the stock stays where it's at above the option that you sold or goes higher, you'll just take that premium. When the option expires, you'll just, the trade will close, it'll expire worthless, and you'll have that money that you brought in. You'll bring in a little cash flow every month doing that. And the downside of it, if you want to call it a downside, is if the stock goes down while you have that naked put on, if the stock goes down and winds up trading at or below that strike that you sold on the option's expiration day, you're going to be put 100 shares of that stock. You'll wind up with 100 shares of the stock in your account. So for the ride or diers of Disney, the folks who will want to get Disney stock or whatever stock at any opportunity they can. Let's just take Disney, for example. So here's the chart of Disney. This was on expiration. This was on earnings day right here. But let's say, let's for example, let's look at where it's at right now. So it's trading at 88.27. And if you're a Disney fan and a Disney ride or dier, you may see an opportunity like if I could own Disney down here, below the lows for the year, like let's say at $77, I would consider that like a screaming deal. That would be a great bargain. And so then you would look up the option chain and see if you could sell a naked put, at the $77 level and how much premium you could bring in. And just for example purposes, I'm just going to throw numbers out. These may not be realistic, but let's say you could capture like say $50 by selling one naked put at the 77 level, and it has, let's say, 30 days to expiration. So basically what that means is over the next 30 days, if Disney stock stays trading above the 77 level where you sold that naked put, at the end of the 30 days, that put will just expire worthless and you'll keep that $50. The trade will be over. You've made $50 on it and you can do it again for the next month. And on the other hand, if you sold a 77 put and during the next 30 days, Disney came down, traded down and wound up trading at the $77 level or below in 30 days, you would wake up the next morning with 100 shares of Disney at $77, and you'd also be able to keep the premium that you took in when you first sold it. So it's kind of a win-win. You get Disney stock at a screaming deal at $77 a share, the lowest point it's been all year, and you get to keep that $50 that you originally paid for selling the naked put. So hopefully that makes sense, and you probably already know what a naked put is, and you already get that. So how this all plays into an earnings play is on earnings, several days before earnings, like a week to several days before earnings announcement on a company, you usually see the volatility rise in the options. Like an option that may typically be throughout the rest of the year, let's say maybe $50, the volatility will come in during those few days that's coming in right before the earnings announcement, because there's uncertainty, and uncertainty causes the volatility levels to go up. So there's more premium in those options. So you can sell them for more than you would usually get throughout the rest of the year during those few days before the earnings announcement, because that volatility is pumped into them. So let's just say we're coming up on earnings announcement, and an option down here at the 77 level, which typically goes for like $50. You could usually get $50 for selling, because earnings announcement is in just a few days, and nobody knows what the earnings announcement is going to say, like how the company's been doing this last quarter or whatever. There's uncertainty. That option at the 77 level, which is usually priced around $50, where you could get $50 for selling it, because of that implied volatility that's coming into it right before the earnings announcement, the uncertainty, you may be able to sell that 77 put for $100, because there's more premium, there's more volatility pumped into that. So it's an opportunity to sell a naked put at increased levels of value where you can get more money because of the uncertainty. And then as soon as earnings announcement is announced, usually that volatility will just come right out of those options, and that inflated price will go back down to its normal levels. So it's like a little window of opportunity every quarter in the few days right before an earnings announcement, where the premiums and the price of the options actually will rise and get bigger and bigger and inflated because of that uncertainty. And then as soon as the earnings announcement is made, it goes back to normal levels. So with the ride or die strategy, what we're trying to do is we find a company that we like and that we wouldn't mind owning no matter what. We're ride or diers for it. And as earnings announcement comes in, like a few days before the earnings announcement, you watch the volatility levels. You can see the implied volatility rising into it. And then you decide to sell a naked put, either where it's currently trading at, if you're a really super hardcore ride or dier, or you can sell it like further down. Like in this situation, I would say let's sell it at the low or below the low for the year. And if I get put Disney stock, if Disney stock after the earnings announcement, tumbles and comes down, that's okay. I don't mind owning Disney at what I consider to be a bargain price. I consider that a win. Any day of the week, I'll take Disney at 77. That's what a hardcore Disney ride or dier would say. And what makes this an earnings play is that this opportunity only really comes up during the few days right before an earnings announcement. That's when these prices get inflated. They're not normally this rich and the premium's not really as big usually throughout the rest of the year. Only these few days leading up into the earnings announcement because of the uncertainty. So once again, the ride or die earnings strategy is that here's a stock that you want to get no matter what. You love this stock and you'll take it at any level. In the few days right before earnings announcement, you come in here and you figure out where you want to buy. What price would you like to buy it at? If you like to buy it right where it's at like 85 or 86, you could probably sell a really nice put with pumped up premium in it. It has a lot more premium in it than it usually does. Let's say like $2 or something. Let's say if you sell it right where at the strike where it's trading at right now, the day before earnings, let's say you bring in $200 and then the next day, let's just say after the earnings announcement, Disney does nothing. Let's just say the next day Disney trades right where it was. Well, if you get put the stock, you now own 100 shares of Disney at the price that it was at already, but you also have that $200 that you brought in on top of it. So you're basically getting Disney for a discount. You're basically getting the stock for the exact same price as everybody else, but you're getting that $200 bonus because you sold that inflated put option the day before. So you could pretty much sell the naked put at any strike you wanted to. Selling it at the money is kind of a common one. Another one is looking for a low like this. So we can see that this is the low for the year, 78.73. So as we come into earnings announcement, a hardcore Disney ride or dyer would say, hey, you know what? I'd love to pick up 100 shares of Disney if it trades below the lows for the year, like over the next couple days. So let's just determine where that's at. So we can see the low on Disney was 78.73. So we might say, okay, I'll sell a 78 put, maybe bring in $100, doing it the day before earnings announcement. Earnings announcement will come out, and if what happens here, if it just stays right where it's at or goes down a little bit or goes up, as long as it doesn't go down to that $78 strike that you sold the put at or below by expiration day of the option that you sold, you've made that extra 100 or $200, however much you sold that for, as bonus, as like an income play, as like a bonus on top of it. And if Disney does come down and surpasses that line where you sold the put at $78 or below, then you'll be put 100 shares of Disney at $78 where the put was sold at. But again, you get to keep that premium that you brought in for selling it. So you're getting a better deal than just going in and buying the stock outright. So that's the ride or die strategy. And again, these are trades that are ideally for ride or diers, folks who want to own Disney or whatever stock you're doing this with. You believe in the company, you're committed to them, you're going to stand by them through thick and thin. That's what this strategy is for. And it can bring in a nice additional income every earnings announcement, every quarter. Or it's also for like if you have a little bit of speculative money, it's kind of fun to play, and you don't really mind. And the worst case scenario is that you wind up owning a good stock as long as you do it on a good stock. So this last week I put on a couple of these on Disney on Thursday on the earnings today, just to kind of show you how it works. So real quick, let's look at those examples. All right, so here's the trades we made. So this was on Wednesday of this week. This was one day before earnings. Earnings announcement was after market on Thursday. So one day before that, on Wednesday, I came in here and I placed these trades. Here's the chart of Disney on Wednesday, the day before the earnings announcement. Down here you can see this little blue icon with a light bulb and that red thing. That's just indicating that following day, Thursday, is the earnings announcement. So you can see right here we're trading right there. The low of the year is at 78.73, and again currently it's trading right there like at 84.48. So what I did, I came in here and started looking at some naked puts to sell, and I did a couple variations just to kind of give you a full explanations of the ways that I would typically do this. So I came in here and I found the 78 strike right here, and let's just go back to the chart for a second real quick to see where 78 is. So 78 is the 78.73 is the low of the year. So this first one I looked at just the options that were expiring 2 days later on Friday, weekly options. See, weekly options really help make this game a lot more profitable and fun and quick, because beforehand, options were only every a month. They were only monthly options, an option every month. So regardless of where the earnings announcement might wind up during the month, you may have to hold on to that position for 2 weeks, maybe 3 weeks, to let it expire worthless. Where now, with most stocks having weekly options, it doesn't really matter where the earnings announcement lands in the week. There's usually a play you can make that will wrap up and finish out within 1 week's time, which is the case with this. Disney had weekly options that expired on Friday. earnings announcement was on Thursday. And so on Wednesday, we came in, we pinpointed the low of the year, 78.73. So as a hardcore Disney ride or dyer may think, let's see if we can get some Disney shares at below the low of the year, like at the best bargain that we could have gotten all year. So that would be the 78 strike. So we come back into the option chain here. We find the options that expire 2 days later, 1 day after the earnings announcement on Friday. And we find the puts over here, the 78 put. And we see we can get between $43 and $46 in there. So we decide we're going to go ahead and we're going to sell that. So this was a real money trade I put on, and we put it into order, see if we get filled at the best possible price to make the most we can on it. And then we wind up getting filled at $44. So we brought $44 of cash right into our trading account. And depending on what happens tomorrow, if Disney stays above that 78 strike price and remains trading above that strike price on Friday, the following day, like 2 days away, we just keep that $44 and the trade's over, and we can do the same thing again over and over and over again if we want. We don't wind up with any stock. We just get that cash, that $44 in, and I'll figure out what the return on that would be in a second. So that's one variation we can do, like, sell a put that's out of the money. Hopefully, like ideally at like a low of the year. That would be a good bargain for a hardcore Disney ride or dyer. And then let's look at the second option I did. The second thing I did was we took a trade. And so then here's one where we sold right at the money. So Disney is selling on that day, it was selling at $84.50. So we just came in right at the money on again, the weekly options that expire in 2 days, 2 days from the day we put this trade on, and with earnings 1 day after this trade was put on. And we just went right to the at the money strike to bring in the most premium we could hope to get and be assigned the stock basically like right where it's at. So we looked up the 84 option chain, and we see we could sell it anywhere from $235 to $238. And we put that trade on, and we wound up getting filled for $231. So those are the two trades, the two naked put trades I put on for the ride or die strategy on Disney. And then let's just jump forward in time to Disney on Friday morning. So they announced earnings on Thursday, 1 day after this trade was put on, after the market closed. So then on Friday morning, we came in and we looked at our positions, and we can see that here's what Disney did after the earnings announcement. It gapped up. It was a positive news. It jumped way up. And again, remember, we've sold put options down in this area and down in this area. So if we look at our positions now on Friday morning, these are the positions that expire the same day. First, let's look at our out of the money put we sold. So that one, this is on expiration day. You can see that we're way out of the money. We're totally safe up here. And we brought in, we'll just let the option expire worthless, and we'll bring in $43.50. So if I do the math on that real quick, let's just figure out what kind of a return that is in basically 2 days. So that is a return of 7,800. So 7,800. So that's a 0.55 return in 2 days for that one. And again, the worst case scenario in this is that if they had gone the other way and tanked, we would have wound up getting Disney stock, 100 shares of Disney stock at $78, which, remember, we are hardcore Disney ride or dyers. We'll take Disney any way we can get it. That's a great deal for us because we get it at $77 plus the $43.50 we get to just keep. Now let's look at the other one we sold, the at the money. So the at the money was the 84. So here's that one on expiration. You see that we're totally safe on this one because it gapped up, and we're going to let this option expire worthless as well. This was a 2-day trade, and this is Friday morning of expiration day, and we have made $230 on this one. So let's look at that return real quick. 84 per share times 100. 8,400, 230 divided by 8,400. So on this one, we made 2.7% in 2 days. And again, same thing with this one. The worst case scenario, if it had gone the other way, if Disney came out with their earnings report and it went the other way, moved against us, we either make $230 and we don't have to get the stock, or we get Disney stock at $84, which as Disney hardcore ride or dyers, we're totally happy with. And we get to keep that $230 on top of it as like a bonus. So that's basically the strategy. And again, you can sell these naked puts on stocks anytime you want. Just what makes this better to do during earnings is if it's a stock you really want, you're a ride or dyer for, and you really want the stock no matter what. This is an opportunity that comes up like 4 times a year. Every time there's an earnings announcement where you can get a max premium on the options that are right around the current trading level. And in this case, you can see we had the opportunity to get Disney at a bargain price, what a Disney Ride or Die would think was a bargain price, below the low for the year, and still not only get the stock at the lowest price of the year, but also get, additional $43 on top of it, kind of like as a bonus. Or in this case, you could buy it right where it was trading at anyway, $84, and either own the stock at $84 and have a bonus of $230 on top of it. Or, as what happened here, just move the other way. You don't even have to take possession of the stock. You just keep that $230 in just a couple days with the ability to do it again and again and again and again. So that's the earnings ride or die strategy. And there's also another really cool earnings strategy that I also did on Disney this same day that I'll just save for the next video. It's another really cool concept and something that I don't see anyone else talking about doing. And I'll save that for the next video. I think it's a really cool strategy and I think you're going to like it. So if you haven't already subscribed to my YouTube channel, just go ahead and hit that subscribe button below and you'll be alerted when that next video comes out. And you can also join me on my website. I'll leave a link to my website in the description below. Just go over there and join me there. That's it for today, and we'll see you next time.